Investing in default-free securities. Before we start to model your option to take risk, what is actually the best that can be achieved with essentially risk-free securities? If you wanted to reach the retirement date with a certain guaranteed account balance, you could invest each year in U.S. government securities, called Treasury bonds. Let's have a look at what is called the Treasury yield curve. The Treasury yield curve is a series of annualized interest rates on U.S. government bonds of different maturities. An investor can earn these rates, or close to them, by buying these bonds and holding them until they mature. You can look this up on websites like thewallstreetjournal.com or Bloomberg, or on the U.S. Treasury website. So as of January 13, 2013, if you bought a one-year security, you could only earn a certain return of 0.15%, or $1.50 per $1,000 invested, and you'd get your $1,000 back as well at the end of the year. You actually would have done better in the bank account that was paying 1%. However, if you bought a 10-year security, you can earn a certain return of 2.03%, or $20.30 per year per $1,000 invested. And you'll get your $1,000 principal back as well at the end of the 10 years. If you buy a 30-year security, you can earn a certain return of 3.19%, or $31.90 per year per $1,000 invested. And once again, you will get your $1,000 principal back, this time at the end of 30 years. Now, I said a certain return, but aren't treasuries risky as well? Isn't it possible that the U.S. government will default on its debt? Recent fiscal problems faced by the government have raised the notion that U.S. government bonds are not riskless. Furthermore, the debt of many other countries that have experienced crises and defaulted on debt, such as Argentina and Greece, was once viewed as very safe. That said, it is still the case that an outright default, where the U.S. government permanently abrogates its obligation to pay debts, is quite unlikely. Much more likely than default will be that the government will create inflation to pay off its debts, so that the dollars you're receiving will not be worth as much over time. Inflation is a form of default. We'll pay you back, but we'll do so in currency that is not worth as much. And that risk is one possible reason that in normal times, the yield curve tends to slope upwards. We will proceed viewing the payments specified by U.S. Treasury bonds as nominally riskless. That is to say, if the bond promises to repay your $1,000 plus interest of $31.90 per year for 30 years, then the government will do exactly what it promised, but without any guarantee of what those interest payments or what the final $1,000 will allow you to buy when that money comes back to you, maybe only a candy bar or a stick of chewing gum. If what you cared about then was arriving at age 67 with a guaranteed nominal amount of money, you could achieve that by buying government bonds of different maturities. Ideally, when you turned 26, you take your new savings and buy a bond with a 41-year maturity. At age 27, a 40-year maturity. At age 28, a 39-year maturity, and so on. Let's consider what happens if each year you could buy a standard treasury bond that would mature at your retirement date. The U.S. government doesn't issue securities that are longer than 30 years to maturity, although some other countries do. So here I'm just going to assume that the yields on those bonds would be the same as the yield on the 30-year bond. The advantage of this over the 1% bank account is that in most normal time periods, you get the benefit of higher risk-free returns when you lock up your money in the government bonds for longer periods of time. When I say lock up, it's not as though you can't access the money at all. You can sell the bond if you want to, but the point is that you might get to do that at a gain, or you might have to do it at a loss. Now, I'm simplifying something here by assuming that all the interest payments you'd receive from each bond can be reinvested at the same rate as the initial bond you bought. Let's go through how the asset accumulation works by thinking about your annual contributions and how each contribution grows over time. To take one of the years as an example, think about the money you contribute when you have 30 years to retirement. In this year, you contribute around $6,900, and you can invest in riskless treasury bonds such that those contributions will grow at 3.19% per year, giving you around $18,000 when you retire. Next, think about the money you contribute when you have 20 years to retirement. In that year, you contribute around $9,300, and you can invest in riskless treasury bonds, such that those contributions will grow at 2.8% per year, giving you around $16,000 from that contribution when you retire. Finally, think about the money you contribute when you have 10 years to retirement. In that year, you contribute around $12,500. You're going to invest them in riskless treasury bonds that will grow at 2.03% per year, giving you $15,000 per year when you retire, and so on. So if you do this for every contribution and add up the balance at the end, you'll find that the total in your account at the end of all this is around $691,000. That's much better than saving in the bank account that earned 1% per year. That only got you to around $485,000 at the end of your working life. Now, you might be able to do a bit better if on horizons where treasury bonds yield less than bank deposit accounts, you use the bank deposit account, but this won't affect the results much. There are important details to this calculation, particularly how I treat contributions that are more than 30 years to retirement. The fact that I assume that interest payments on the bond can be reinvested at the bond's initial yield to maturity when you bought it, and the way that I interpolate between points on the yield curve. But these are not that material to the main calculation. Now, you might hope for higher interest rates in the future on riskless securities. You might hope that in, say, 30 years, when you're 55, you'll be able to get a better than 2.03% rate on risk-free savings in the remaining 10 years. But in financial markets, the best forecast of tomorrow's long-term rates are today's long-term rates. Rates on safe securities might be higher in 30 years than they are today, but they might be lower. So, what have we learned about investing in securities with guaranteed nominal returns? The most important observation is that in most normal times, the longer the horizon over which you do not need to touch your money, the higher return you can get on guaranteed securities, or at least nominally guaranteed securities. Your spending power with those dollars is not guaranteed. In the language of economics, we say that the term structure of default-free interest rates is usually upward sloping. And while you might hope for higher interest rates in the future, that is not a certain proposition. The only thing that is certain is today's rates for securities held to maturity. What we haven't considered yet is your ability to take risk, which introduces a distribution of possible outcomes. Some of these outcomes are better than risk-free rates, but some of those outcomes will be worse than risk-free rates.